I assume you know what an assumable mortgage is. You don't? Well, here's some information for you. An assumable mortgage is an arrangement in which an outstanding mortgage and its terms can be transferred from the current owner to a buyer. When interest rates rise, an assumable mortgage is attractive to a buyer who takes on an existing loan with a lower rate. Buyers must still qualify for the mortgage to assume it. What types of loans are assumable? FHA, VA, and USDA. When does it make sense? If a buyer is purchasing a home for $250,000 and the seller's assumable mortgage only has a balance of $110,000, the buyer will need to make a down payment of $140,000 to cover the difference, or the buyer will need a separate mortgage to secure additional funds. When does it not make sense? When the home's purchase price exceeds the mortgage balance by a significant amount, requiring the buyer to obtain a new mortgage. Usually, a buyer will take out a second mortgage on the existing mortgage balance if the seller's home's equity is high. The buyer may have to take out the second loan with a different lender from the seller's lender, which could pose a problem if both lenders do not cooperate with each other. Also, having two loans increases the risk of default, especially when one has a higher interest rate. If the seller's home's equity is low, however, the assumable mortgage may be an attractive acquisition for the buyer. If the value of the home is $250,000 and the assumable mortgage balance is $210,000, the buyer needs only to put up 40 grand. If the buyer has this amount in cash, they can pay the seller directly without having to secure another credit line. So don't assume this is the best option. Contact me today and we can find out what your options are.